So as I was saying, everyone's circumstances are unique, so the discussions here shouldn't be viewed as personal advice or a recommendation for a course of action, but hopefully they do give you something to take away. So without further ado, we are going to crack on. So with our first case study, we've got Madeline. She's 57 and she wants to start her income retirement planning journey. Now, Dee, could you talk us through some of the things that she should consider here? And Dee, you are on mute. We cannot hear you.
Sorry, forgive me for that. So, yeah, Laura, thanks for that. When helping clients plan their retirement income strategy, the focus extends beyond the financial figures and it encompasses the client's personal aspirations, their lifestyle preferences and their family dynamics. And in the case of Madeline, age 57, to help plan her retirement, it's best for Madeline to just make sure she sits down and actually gains a thorough understanding of her life goals and her vision for retirement. And that actually is what becomes the foundation for crafting a comprehensive retirement plan. And the reason I say that is retirement means different things for different people. So in Madeline's case, her sort of vision of retirement was not only stopping work, but she wanted to embrace some new opportunities and she wanted to maintain a certain lifestyle, which she was sort of confident of the lifestyle that she wanted. And actually, that's one of the most crucial things to understand, because when looking at retirement, you're effectively planning for the longest holiday of your life. And it's important to think about how you're going to spend your days, both immediately but also in the long term, because that then helps to identify what you need to achieve that. So when considering retirement planning, the things to consider are, if there's a specific lifestyle in mind, actually what is that lifestyle and what's it made up of? So with Madeline, her vision was a couple of holidays to Europe a year. She also wanted to be able to eat out when she wanted and maintain memberships both of her golf club, but also the gym where she loved going to regular yoga classes. So actually, with a picture of the lifestyle she wanted, the next step is to quantify actually how much is needed to do what Madeline wants to do. So in maintaining the lifestyle that she wanted, she calculated that as a household, she'd need an income of £46,000 a year net, and 10,000 of that was actually made up of desired travel with her partner. So that helps to highlight the importance of visualizing how the time will be spent, in order to help build a realistic income forecast of what's actually needed. And with that forecast, we always look at actually how much do you need to spend. So where the income comes from in retirement will depend on whether there's perhaps tax on it. So we always look at how much do you need to spend, rather than planning from the other direction of where to get it from. Where to get it from, we look at towards the end. So I'd suggest to Madeline that she sits down and actually works through the various sources of where she can generate her income in retirement. And from that, to actually understand at what points in retirement she'll need to lean on any pensions or savings to cover any shortfalls in the income to actually meet that 46,000 a year expenditure that she wants to make. And then also thinking about her transition into retirement, whether she wants to actually stop work completely, or whether she perhaps wants to keep her hand in part-time or maybe do some consulting work, because that all helps to work out what level of shortfall she'll have. The other important thing that we'd always suggest for Madeline to think about is to make sure that she has enough secure income to cover her essential expenditure in retirement. So secure income is the type of income you know will always come in and it won't go up and down, perhaps with markets. So it's income you can rely on coming in, and there's no sort of variability to it. And we would also suggest that Madeline thinks about, will there be any potential fluctuations in her expenditure over the course of retirement? So, for instance, if she wants to travel more in the early years, they might be more expensive than later years. And then sometimes in later years, with needing to have help with things like the garden, occasionally that will add to the income needed in later years. So it's always worth thinking about retirement in the different stages. The first 5 to 10 years after retirement, then probably in the age 70s, and then again from 80s, to actually visualize at each of those milestones, what do you think you'll need? And then beyond looking at those personal needs, it's important for Madeline to look at any financial dependence within the family. Either is anyone reliant on Madeline, or is she reliant on others? And with that, thinking about any potential changes in lifestyle, either for Madeline or her household. So, for instance, on the death of either a spouse, a civil partner, or a life partner, there will no doubt be changes in the household income. Some pension income might be lost, depending on the order of which partner went first. So just thinking through how things would be if one or the other of an income generator in a household wasn't there. We would also always suggest Madeline to make sure that she has an emergency fund to give a financial cushion. And in retirement, we would always suggest an emergency fund of in the region of 1 to 3 years worth of expenditure, because in retirement, it's less easy to recover from financial shocks. The other thing that I would suggest that Madeline thinks about is looking at annuities, and if she has any particular health or lifestyle factors, they might actually mean that she's eligible for an enhanced annuity rate. So that means that when she buys the annuity income, she would actually get an enhancement. So things like high blood pressure, high cholesterol, any medical factors, height and weight, they can always qualify for enhanced annuities in some cases. So it's always worth, if a client has any factors like that, to actually look at, could that lead to any enhanced rates? So I'd always suggest that Madeline has a look into that. And then in terms of the different savings that she's built to help her in retirement, to consider actually who does she want to pass any wealth on to, should anything remain when she passes away, and also is passing wealth on to someone else something that she would like to do, because if not, then she potentially would have more of her savings to use. So it's always a good idea just to get an idea of what you might want to happen once you've gone on. Is there a legacy that you want to pass on? So hopefully that gives a good idea of the things for Madeline to think about. And the really important thing to remember is she is unlikely to know the answer to those questions from the first point that she sits down to think about it. So I quite often help clients to visualize how they want to spend their time and build the picture of what they want in the early stages of retirement planning meetings. And to help clients, it's always worth looking at the retirement living standards by the Pension and Lifetime Savings Association. So they've got some great tools available that show different lifestyles and costs in retirement. And it's a really helpful tool to look at, because it helps build a picture of the different areas to think about, and also the costs of different lifestyles. So it's just really helpful to frame a picture of, have I got all the right things in my list, or are there other areas that I perhaps hadn't thought about? So we'll pop a link in the chat for you to have a look at the Pensions and Lifetime Savings Association research in your own time. But the important takeaway is the pursuit of a fulfilling retirement. The approach is to consider not only the financial aspects, but also the personal aspirations, family dynamics, and any potential changes in your retirement years. And the ultimate goal of a good plan is to provide the confidence of being able to maintain the desired lifestyle. And that confidence quite often will help a client to remove the weight from their shoulders on worrying, am I able to retire, and allow them to retire and then enjoy later life. So hopefully that's a helpful list, Laura.
Absolutely, definitely. Thank you so much for that. Quite a lot of our questions submitted before the webinar happened, which we had a lot of, which is absolutely great, were surrounding pension planning and retirement planning, and rightly so, as that's probably one of the biggest shifts that everybody's gonna feel in their lives. So we've got a couple of questions that have come through that I'd like to ask now, Dee Dee, if that's okay. So
Yep.
One of them, and I'm sure there's a lot of people who feel like this, was that when you start the planning process, it's quite overwhelming. There are a lot of pensions here and there. You don't know where to start. Obviously, we're not educated in this in our general lives. So is there a sort of stepping stone advice that you'd give of where to start and where to sort of get on top of it and build your confidence in pension planning and retirement planning?
Yeah, absolutely. It's a very good question, and the word overwhelming is an apt one. Quite often, it is overwhelming for people to think about because there is so much to think about. But I would always suggest just take it one step at a time and actually build your plan in bite-sized chunks. And it's not something you need to wait until you're 57 if you're going to retire at 57. If you start planning earlier to visualize what you want, then it can be less overwhelming by sort of thinking over a longer time period. And with pensions, if you have a number of different pensions from different employments, it can also be really hard to keep track of them. So one of the easy ways of keeping track of them is, or trying to work out perhaps what you've got but forgotten about, is to sit down and write down a list over the years of where you've worked. And if you can remember the years that you worked at that place, write it all down either on a piece of paper or in a spreadsheet, and have for each employment roughly when you worked there, and what the name of the employment was. And if you can remember it, the pension plan that you remember of, and then if you've actually got details of recent valuations from the pension plan, pop that down in that spreadsheet or list as well, so that you can build a picture of what plans and savings you've had over the years. And for sometimes people actually lose track of their pensions, and that can be really worrying. But there is actually a pension tracing service. So by doing the list of what you think you had, and then a list of what you know you have from the valuations, then you can identify actually, are there any missing gaps? And if so, have a look at the pension tracing on the internet. Then you can actually hopefully help to track down any missing pensions. And the longer you give yourself, the less overwhelming it is. And the other thing that it's important to remember is the state pension. So if you go on to the gov.uk website, you can get a forecast of what state pension you're entitled to, and also when you'd be able to claim it. And it's really important to have a look at that just to make sure, does it look right? If you think you should have had 15 qualifying years and it's only showing 12, for instance, it's worth actually looking at, is that record complete? And particularly if you weren't claiming child benefit and looking after under 12s, then it might be that actually the record needs updating, and contacting to update that well in advance of retirement is a lot less stressful and takes the time pressure off.
Brilliant, thank you. I think I'll be taking that advice back home and writing down all of the jobs I've had, because when I was younger, I was quite a job hopper, I must say. We do have a couple of other retirement planning questions in the chat, which I will address at the end. I'm just conscious of time, so we will get to them. I just want to get through the main content of the webinar first, if that's okay with everybody. So moving on to Sarah. So navigating divorce, this is obviously a huge milestone in anybody's life, really. Um, we have Helen, she's aged 47. She's decided to begin the divorce process with her husband. Obviously, this has significant financial impact as well as emotional and well-being. So Sarah, would you like to take us through things to consider there?
Yeah, certainly. Thank you, Laura, and thank you, everybody. Having recently gone through this myself, absolutely appreciate how hard it is to actually split up and go through the whole divorce process. Clearly, it has to mean, or it means that you have to come to agreements with someone that you've already decided that you can't have a relationship with. However, there are a few steps that you can take to help ease the pain out of the whole process. It does help, and again, speaking from experience, if you can try and keep things as amicable as possible and try not to let the heart rule the head. You don't have to stay friends with your ex, but the more that you can, or the more that Helen could agree with him, the less she has to spend on lawyers. And this obviously goes to the financial settlement, but also for any arrangements for the children. If and when Helen does need to use lawyers, it's even more of a reason not to let any disagreements drag on, because each niggle that you have will just escalate the legal fees cost. A straightforward divorce might be something that Helen feels that she could handle on her own. But if she's got any pensions, any property, significant savings, investments, or if there are any children to think about, then speaking to a lawyer and a financial advisor are really good ways to protect Helen from making an expensive mistake. If Helen does feel that she needs to talk to someone about the emotional upheaval of getting a divorce, then we would suggest that Helen make sure she's using the right specialist for that too. Talking through any anger or any challenges with a lawyer is expensive, and they're not going to be able to help as much as a counsellor could. The other thing that we would say is that Helen doesn't feel that or advice to Helen is she shouldn't feel like she needs to make any quick decisions. She should take time to pause and reflect on any proposals, read any paperwork with a clear mind, and try to look towards the future when considering any decisions. And what we generally find, and what's really important, is that if Helen's spouse has been building up a pension for many years, then pension specialists are particularly valuable. It might make sense to get a pension valuation as part of the financial disclosure, and it can be worth having an advisor to then check those numbers. This also then can fundamentally help Helen to pick the most appropriate ways to share the pension. For example, whether one person keeps it and trades it against other assets, or you could split the pension pot into two, or Helen can agree to share it when it's being paid out. You've got different options. After the split and after the divorce is sorted, Helen should then revisit her pension arrangements and work out how she can manage some of the changes to her finances as a result of the divorce. And finally, of course, Helen would need to assess where she is financially and start rebuilding her finances as soon as possible. If Helen has run up any debts or spent her emergency savings on the divorce, then paying them off and building back emergency savings are a real priority. And we usually recommend 3 to 6 months worth of essential spending in an easy to access account if she's working, or as Dee Dee said in her last case study, or 1 to 3 years if she's not working. And last but not least, Helen shouldn't forget about insurance too. She should check what she has in place to make sure it all still suits. And if she is relying on maintenance payments, she should consider insuring the life of the person paying them to protect her family from such an eventuality. Thank you, Laura.
Brilliant, thank you so much. I think that's key, isn't it? Looking at the pension. I know a lot of people often focus on the home, so just bring everything into your planning. So moving on to Sandra, who has quite a nice problem to have, I'd say. She's had a promotion at work, and so she is now benefiting from more income than before. So she wants to make sure that she's doing the right thing with this additional income. As I said, lovely problem to have. Jess, what would you recommend and give guidance to Sandra?
Yeah, thank you, Laura. As you said, it's probably not the worst problem you could have, but there are certainly a few things that Sandra could be thinking about. And I'd firstly suggest looking at any outstanding liabilities that she may have. So does it make sense to maybe repay any loans off early to save on some interest? Alternatively, if she's got a mortgage, possibly looking to make some overpayments there. The second step would be considering protecting her income. For example, if she ever were to become ill or to suffer an accident that could result in her being unable to work, that could have a really significant impact on her finances. And that's why protection insurance is so important. I'd suggest she actually checks with her employer first to see if they offer any form of protection benefit. And the third point would be, again, as Sarah's mentioned, looking at the emergency fund. But above this, also considering any planned upcoming expenses that could be on the horizon and making sure that these have been budgeted for and that she's got the cash set aside ready so that those can be paid for when needed. So once Sandra has calculated how much money she should be holding as cash, it's then time to think about what she's doing with her cash. So any money that's not needed for day-to-day expenses could actually be moved out of her current account and into a savings account to hopefully earn a bit of interest. And when reviewing your savings accounts, always make sure you're shopping around. Hargreaves Lansdown Active Savings Service is actually a really useful tool for doing this. So it gives you access to competitive rates from lots of different banks all in one place, and you can access it via an online account. So we'll pop a link to that in the caption if anybody wants to check it out. Just be aware that with your cash, if the savings rate is lower than the rate of inflation, then actually the spending power of your money would be reduced over time. So after considering the above points, if Sandra is still left with some surplus income and some additional cash in her current account, which isn't required for the foreseeable future, she could then move on to think about some other options. And one thing to start with could be planning for later life. So she's built up this short-term financial resilience, but then it could be worth thinking about the longer term and specifically thinking about her retirement planning. So as Sandra is employed, she would have been enrolled into a workplace pension, and this will be her main vehicle for saving for retirement. But now that she's got this higher salary, is there any scope to increase her pension contributions? And again, she should check with her employer, as some companies may actually pay in more if you increase your payments. Pension contributions benefit from tax relief, and if salary sacrifice is available, you may also be able to save on national insurance. So it's a really cost-efficient way to be saving for the future. However, keep in mind that pensions are essentially a really long-term savings account. And under the current rules, Sandra wouldn't be able to access this money until she's 57. So in order to maintain more access to her money in the shorter term, she may also want to consider the use of ISAs. And this could be a cash ISA from a bank or building society, or you can also look at stocks and shares ISAs if she wanted to start investing. And generally speaking, ISAs are still tax efficient, but they offer a lot more flexibility than a pension, and you could access the money sooner if needed. Under the ISA umbrella, you can also find the Lifetime ISA, into which you can contribute up to £4,000 a year and receive a bonus of 25%. They are primarily aimed at those looking to buy their first home, but Sandra's already owns a property, so she could actually use the Lifetime ISA towards retirement saving. Now, lifetime ISAs and pensions do have different tax treatment as well as different withdrawal and contribution rules. So making sure that you're fully informed on all of the information is important, and then weigh up the options to work out which is best. And if Sandra were a parent, she may also wish to look into junior ISAs as a tax efficient account for saving for her children if they're under the age of 18. And again, as with an adult's ISA, this could be cash or it could be stocks and shares. After considering all of this, if Sandra does want to start investing, possibly within a stocks and shares ISA, she should then consider the pros and cons of investing in the stock market. For example, there could be a high potential for growth if you're investing in the stock market than there is on cash, but this usually comes with a higher level of risk as well. So to take the first steps towards investing, I'd suggest that Sandra starts to learn about different asset classes, meaning looking into shares, looking into bonds, as well as understanding how a fund works and the importance of diversifying her investments to help reduce the impact of market fluctuations. But with investing, always keep in mind that really they should be there for the long term. And generally, we suggest investing for at least 5 years or more. Because unlike the security of cash, investments can go up and down in value, and you could even get back less than you originally invest. So just keep that in mind. And also tax rules can change and the benefits would depend upon your personal circumstances.
Brilliant. Thank you so much, Jess. I think we're staying with you now to talk about our case study, Belle. Belle and her partner are ready to start a family and they'd like to know what to consider from a financial point of view. Having just recently been through this myself, I am very aware of how expensive having a child is that nobody talks about until you get there. So anything, tips and guidance that you give, I will be passing on to all of my friends. Over to you, Jess.
Yeah, absolutely. As you said, it can certainly be an expensive time, but there are a few things you can think about ahead of it just to make sure you are as prepared as you can be. So the first step I would say is budgeting, and hopefully they are already working out an ongoing budget of their finances, such as their household expenses, their utility bills, and so forth. But to prepare for their first child, they should also start to research, firstly, the initial expenses that will happen, as well as how their ongoing expenses are likely to change in the future. And this budget can continue to be amended as they figure things out, but by staying on top of it as early as possible, they can check whether their income actually matches their outgoings. And really, this should be an open conversation between them as a couple. The second step I would suggest is considering maternity leave and, of course, maternity pay, because it's likely that Belle would take time off towards the end of her pregnancy and during the baby's first year. So they should really think about how this will impact their finances and whether this would cause a reduction to their total income. So Belle should check that she understands what her employer may offer in terms of maternity pay, as well as the government's statutory maternity pay as well. And they could also consider having shared parental leave as a more flexible way to take time off during the baby's first year. The third step to think about is reviewing their expenditure. So hopefully at this point, they've worked out what their budget is, they've thought about how things might change in the future, but it's also worth seeing whether or not there's any room for improvement now to provide them with more financial resilience. And this could be particularly the case if Belle is going to be taking a longer maternity leave and also thinking about those increase in expenses after the baby arrives. And to do this, they could split their expenses between essential and non-essential. And then with those non-essential items, they can prioritise them to think about what's truly important to them and where they want to be spending their money. So, for example, her partner may not want to stop his gym membership, but maybe he'd be happy making lunch at home a few times a week to take into the office as a way of reducing their weekly expenses. And whilst reviewing these things, it's also useful, or could also be beneficial, to shop around for better deals on any existing utility bills, such as Wi-Fi, and also thinking about things like your TV packages. Are you still watching Netflix on a regular basis? Is it still worth paying for that? The fourth step is moving on to debt. So it's key that the couple check if mortgage and loan repayments can actually be maintained, particularly if Belle is going to be on a reduced income during maternity leave. And they should also look and see if there's any scope to reduce this outstanding debt now, again, to give them that more financial resilience. And the fifth point is savings. So again, making sure they've got that emergency fund in place, but also reviewing this and continuing to review it, because 3 months worth of essential expenditure now might be quite a bit less than it would be after the baby arrives. And then a few further thoughts maybe for later down the line. Of course, there's the cost of childcare, and I'm sure I don't need to tell anybody about how expensive that can be, and that can really have a significant impact on their finances. And the second point really leads into that, and that is checking whether there's any benefits that could be claimed, as that could give them a really welcome boost, particularly once they've had a child. And for Belle, it's also worth thinking about the longer term with her career. So will she be returning straight back into full-time work after maternity leave? Could this be on a part-time basis? Or is she maybe planning to take a longer career break? And part of this conversation could be weighing up the option of having that higher income by working full-time versus the expense of then having to pay more in childcare. And of course, there's always the personal preference as well. And the next point would be particularly important if she were to take a longer career break, or if she is maybe returning on a part-time basis, and that is reviewing her pension. Because by taking that career break or not working as much could mean that her pension contributions are reduced or possibly even missed for quite a while. So it's worth thinking about if in the future she will return to full-time work, is there any scope to make up those pension contributions by putting in a bit extra when she can? And on a similar line, also checking any missed national insurance contributions, as these are also really important. And she should look into whether she should be making up any missed payments, as even though it's a long way off, this could impact her state pension and possibly other benefits.
Brilliant, thank you, Jess. And I can certainly attest to my emergency fund being hugely different pre and post baby. So we've got a final case study now, another very lovely problem to have, and then we will have time for questions. So thank you so much, everyone, popping them into the Q&A area. We've got some great questions, and thank you, everyone, for bearing with and hanging on with the technical difficulties and throughout. So we know we're trying to cover a lot here, but we will get to your questions shortly. So we've got Natasha, age 26. She is keen to take a year out to travel Australia, which is just fabulous. She wants to know what impact that might have on her finances and what she should consider when she comes back. So Didi, having a career break for such a fabulous reason obviously has an impact on your finances. Could you talk us through what Natasha might need to think about?
Yeah, absolutely, Laura. So with the visa restrictions having lifted in Australia in 2023, Natasha, who's, as you said, 26, has decided to take a career break because she wants to travel the Aussie coastline. And she's aware that leaving her well-paid job will have considerable impact on her finances, but she just wants to check, has she actually thought about all of the main areas? So before deciding to take the plunge or finalising her decision and taking the plunge, I'd suggest she has a think about the duration. So how long does she want to go for, but also how much can she actually afford? So traveling can have a big impact on finances, but it's really important, as well as looking at how much money you have, actually thinking how much of that do I need to actually earmark and set aside as my emergency fund, just in case I need that backup. So we would always recommend, as been already mentioned, around 3 to 6 months worth of essential expenditure. So I would always recommend that actually you start thinking how much money I've got, excluding that emergency fund, so that you still keep that emergency fund there just in case. And once she's actually worked out how much she can actually afford to use on traveling, to actually do a budget and make sure that she considers spending within the means of that budget. The other areas to think about, aside the traveling, are the impact on her career. So will going away for a year or 6 months affect any future promotions or bonuses that she'd receive? And also the impact on, would she have a job to come back to? So it's not only the cost of the career break in terms of how much financially that break costs, but the costs in terms of knock-on effect on life are also worth thinking about, just to make sure it's something that you're comfortable with. In terms of holidays, it's always worth looking at what holiday allowance there is at work, and perhaps trying to actually centre the career break either side of the holiday allowances, so that you can maximise the use the holiday allowances and sort of take less of a chunk out of time that you're not being paid for. And perhaps maybe even cutting down the length of time that she'll travel for. Looking into at work, does work actually offer sabbaticals? And if so, are there any days that you would get given from the employer for a sabbatical, perhaps after a certain age, maybe looking at would it be worth delaying it by a couple of years? The other thing I'd always suggest she thinks about is her existing debt. So if she's got existing debt, what's her plan for paying it off while she's away? So that can also have a significant impact on budget, because if it's outgoings that she needs to make because there's a fixed payment that needs to be made each month, she needs to work that out in her holiday budget, because it will of course still be a cost that she needs to meet. And then in terms of meeting those costs, actually thinking through her saving, how's she going to save to get the money together that she needs? So if she's not planning to travel for a while, she could always consider using a fixed rate savings account so that she can get a little bit higher interest for locking the money away. And that way she can actually make the money work a little bit harder while she's waiting to go off on her travels. The other thing to think about is within those travels, does she want the entire time to be work free, or would she consider either working part-time while she's actually out in Australia, or perhaps could she do any remote work for her existing employer and kind of do a mix and match of the traveling with some work, and that way she can stretch her time out for longer by having a little bit of income while she's out there. If she can get a small income coming in, then she won't have to dip into her savings quite as much. So these are all sort of the things to think about, but it's also not just the financial impact of going away, it's actually the impact of when she gets back. So some things to think about with regards to that are, what would be the impact on her saving for later life? So if she's going to miss out on the national insurance contributions and pension contributions, how can she bring them back up to date? And as Jess said, will she actually be able to save a little bit more to make a few larger lump sums to make up for the contributions that she couldn't make when she was away? And in terms of short-term savings, how will she actually build her savings buffer up when she comes back? Has she got a plan to maybe be a little bit more quiet in the first few months so that she can boost her savings a little bit, having depleted them when traveling? And also, with regards to when she gets back, where will the income come from? So does she have a guarantee that her current role will still be there for her, or will she need to find a new role? In which case, she'll need to build in a contingency of, if I can't find a new role for a couple of months, will I be okay? So there's a lot of things to think about, and hopefully that list is helpful.
That's brilliant. Thank you. My sister's actually going to Australia at the end of the year, and I'm sure she's thought of absolutely none of these. So I shall definitely forward the recording on to her. So that's our case studies. Thank you, everyone, for all of the questions, which we will shortly move on to. It looks like a lot of them are centred around pensions and retirement planning, which I think we would have expected. So it might be an opportunity for us to think about a more specific event next time. So thank you so much. Do keep your questions coming in. Obviously, we've spoken about some significant milestones, and you can see just how intricate they are in all of the things that you need to think about. Sarah, would you like just to take a couple of minutes to talk about why financial advice might be the way to go when you're hitting a life milestone?
Yes, certainly. Thanks, Laura, and thanks everybody for listening to our case studies. Of course, in Hargreaves Lansdown Advice Team, we recommend that you take advice. Hopefully you'll have seen from the case study that the decisions that these ladies are taking are really big decisions, and those decisions would be, cover you for what could be 30 to 40 years. And for those not working in the financial services industry, this is a complex area with what can be deemed alien terminology, and the implications of getting it wrong could be costly. So an advisor not only would take the weight off a client's shoulders, but it will help the client in having the peace of mind and confidence in knowing that a sensible strategy has been designed by a professional that maximises those tax allowances where possible, which is also important. Of course, you can find out more about financial advice using the QR code on the screen, or you can find me on LinkedIn. Would be happy to connect. Thank you, Laura.
Brilliant, thank you so much. Yeah, so the QR code's there if you wanted to use it, but we will move on to questions. So thank you everyone for being so engaged. So we've got a lot around retirement planning. So Dee Dee and Jess, I don't know how you want to jump in on these. So one of them is, after the age of 75 years, can you still withdraw 25% tax-free from your pension? And Dee Dee, did you want to take this one on?
Yeah, so that will depend on your personal circumstances. So after the age of 75, and again, just bear in mind that the rules around the lifetime pensions allowance are actually changing into next tax year. So I'll just answer this very generally, but it's really important to actually look at it in relation to your own personal circumstances. So as a general answer, over the age of 75, if you still had an allowance within which you could take tax-free cash, that stays with you over the age of 75. But instead of it being called tax-free cash out of uncrystallized money, in terms of pensions terminology, and Sarah did mention it can be alien and not necessarily easy to follow, but after the age of 75, if you haven't accessed the pensions, they become classed as what's called unused funds. And if before the age of 75, you still had some ability to take tax-free cash, then over the age of 75, the allowance simply is then taken out of the unused funds. So the answer to the question is quite possibly yes, but it does depend on your underlying circumstances. So it's something, if you've got a specific issue that you want looking at, I'd always recommend speaking to a professional so that they can actually do the calculations and give you a precise answer that relates to your particular situation rather than a sort of a technical rule.
Brilliant, thank you. You touched on this within your retirement planning case study, but we had a couple of questions on social, and we've got one from the audience here. So it's just on about enhanced annuity options and talking about particular health conditions. What do you need to consider for this? Who can qualify for it? Are there any things that you need to we need to know about, really?
Yeah, absolutely. So there are a number of annuity search engines around, and if you want to look into it yourself, if you go into an annuity search engine, quite often you'll have the option to put in lifestyle information and medical information. So the things that get taken into account are, do you have any medical conditions? And with those medical conditions, actually, what is the name of the condition? When was it diagnosed? What medication are you on? What dosage is it? And with your health and lifestyle, it's your height. You need to know your height. You need to know your weight. In terms of if you're a smoker, how much you smoke a day. If you're a former smoker, when you stopped smoking, how much you smoked. Your alcohol consumption each week, again, that gets plugged in. And then anything to do with your medical history. So if you've got high cholesterol, then the engine will usually ask you, actually, what was your last reading? So, and then with high blood pressure, what was the blood pressure reading? And if you've got medical conditions, are you still under a care of a consultant? So in order to actually, if it's something you want to look at yourself, just make sure that you've got in front of you a list of your conditions and your medication, and ideally, if you can, the dates of diagnoses. When I give advice to a client on annuities, I will always look at what the standard annuity is with no such information, but also, are they eligible for an enhanced annuity? Because there can be differences in costs when you're going for an enhanced annuity or a standard annuity. So I would always look at, is the enhancement that condition gives them, does it still end up with more income at the end of it? Because if not, then we wouldn't want a client to incur higher charges than they need. And there are also annuity medical questionnaires that can be filled in If you don't want to do it actually in a search engine, then getting a questionnaire to fill in, and that will let you know whether it looks like you've got enhanced rates. One thing I would add is it can sometimes take, where questionnaires are being sent off to annuity providers, it can sometimes take a few weeks to get the results back. So it's not something you would necessarily get back immediately. So as with everything, building a bit of time in to give yourself time to do the research and get the information so that you're not having to make last minute panic decisions is something I'd always recommend. So and also with enhanced annuities, if you think when you're about to fill in an insurance form, say perhaps for medical insurance or travel insurance, the more information you put down, the higher the insurance premium. Well, with the enhanced annuities, it's actually sort of the inverse of that. In the more conditions you have, generally speaking, if you're eligible for enhancement, generally speaking, it enhances it. So even if you're not sure, would this qualify for an enhancement, pop it down. If it won't qualify for an enhancement, then the annuity provider won't offer an enhancement. But if it would have qualified and you didn't tell them, they can't take it into account. So, don't try and judge yourself. Is this important enough to write down? If it's a fact that exists with you, pop it down, and you'll then find out whether it's eligible. And it's also really important that when you give the information, that it's actually reflective of your situation, because the annuity provider can actually sometimes go off to your doctors to actually get a report from them. So to just kind of make sure that the information you give, if you're not certain about it, that you put a rough range, or you ring your GP and just say, I had such and such a condition, can you just help remember what that date was?
Brilliant, thank you. Plenty to consider there. We do have a question on defined benefits pension. So obviously these are notoriously complex. So it had to be a very, very general answer, but worth noting. So we've got someone on the call who is lucky enough to have a DB pension. I don't think we see them much anymore, or certainly don't have new ones coming through. So what factors should determine what you do with a DB pension? So whether you take it as a lump sum. So this person in particular is thinking about pulling it down this summer at age 55. Jess, DD, I'm not sure who wants to take that one.
So I think with that question, it's really important for the person asking the question to actually get formal advice that's bespoke to them, because they can be very complex, and also the decision on taking a defined benefit pension and when you take it, there can be implications from getting it wrong. So with a defined benefit pension, it will have a normal retirement date. Sometimes you'll see it referred to as a normal retirement age or a normal retirement date. So you might see it abbreviated to NRA or NRD. If the normal retirement date for that particular person's defined benefit pension is age 55, then the implications of taking it would not be as significant as perhaps if the age for it was age 65, in which case there could be a tremendous reduction in the annual income on something that's called early retirement factors. So in this instance, with a defined benefit pension, I would strongly suggest actually speaking to an expert about it, so they can actually look at, and they would need to see the scheme particulars. They would also need to understand the individual, their circumstances, their wider financial holdings, and any other relevant information about what their potential liabilities and commitments are before being able to answer a question like that. So I'm afraid that's not one where we can give a general answer that would be helpful without knowing more about that person. And then it does extend into actually needing to be personal advice rather than general information.
Absolutely brilliant. Thank you so much. And we've got time for one more question, I believe. But before I do answer that, I'm just going to leave the important information up. So this comes from our compliance team, but it does reiterate that nothing that we've said today could be construed as financial advice. It is just guidance, and that's why we have based it on case studies. But if you have any questions or queries, please do seek financial advice to understand the best course of action for you. So we do have a lot of questions around inheritance tax that's come through on social, email, and in the chat here. I obviously won't go into any specifics, as obviously it's again quite individual and unique to yourself. But when you're thinking about inheritance tax, what are the sort of general things that we need to bear in mind?
It's a really good question, and again, it is entirely driven on the actual individual person and things like what is the total value of their estate? Would there be a taper to any of their allowances because of the value on it? There are also, in terms of nil rate bands, everyone in the UK has a nil rate band of £325,000 on the supposition that they're both UK resident and domiciled. So again, a client understanding where their position is in tax terms, are they UK relevant and domiciled, is also very, very important. But if we look at it in general terms, the nil rate band is £325,000. On top of that, there's a residence nil rate band of £175,000, but that can only be used against the value of an estate if that main residence is being passed down to what HMRC define as direct lineal descendants. So again, there's a lot of under the bonnet information that needs looking at for someone to get an answer that is relevant to them, and any gifts they may have made in the last 7 years, and perhaps even looking back as far as the last 14 years, can have an impact on their estate. And if they're married and their late spouse or civil partner passed everything to them, then they may have inherited 100% of their ex-spouses or civil partners' allowances, thereby giving them double allowances. And furthermore, if they've been previously widowed, they might have inherited it from the late spouse, which then brings in dynamics of the order of how things are actually planned for them. So again, it's something I would strongly recommend actually seeking advice based on your personal situation, because just telling you what the allowances are, you might actually misinterpret how that relates to you personally. We do have a guide that's available, a guide to inheritance tax that goes through the allowances, but what it can't do is interpret, are you different to these standard allowances and does something else apply to you?
Yeah, brilliant. So hugely complex. That is an hour, guys, and that went so quickly. So thank you so much for everyone who has joined and taken their time to join us today. It's been absolutely brilliant. And thank you so much to Dee Dee, Sarah and Jess for presenting. I think you'll all agree that they were absolutely fabulous. Please do drop any feedback or any other content, events, webinars that you'd like to see moving forwards. It sounds like we could potentially go down some more specific routes with all the questions that we have received, which is fabulous. So an email to you to be financiallyfearless@hl.co.uk. So feedback and content and ideas also very welcome. But thank you for joining us. Thank you for your time and have a lovely afternoon. Goodbye.
Thanks all. Bye.